could be headed from here on. We have Varun Goel joining us from Nippon India AIF to take some questions. Varun, thanks for joining us. And, I want to begin this chat by asking about what's going on in the broader markets. We've seen this remarkable rally in the small caps, but do you think we've entered somewhat of a situation of euphoria here? Are the valuations looking too frothy to be able to get in at this point, or do you think that there's more room to go from here on as well?
Good morning, Pavitra. Thanks for having me on the show. I think broadly, if you look at Nifty, we are trading at around 20 times FY24 earnings, which is slightly higher than what has been the historical 10-year average. But if you know, a few months down the line, come Diwali, market will start looking at FY25 earnings. And on that basis, we are trading at around 17, 18 times, which seems more reasonable. I think there have been pockets of froth in the small and the mid cap space. So I think one needs to be a little cautious on that side. But broadly, if you look at the whole basket of stocks, I think because last 1.5 years, we have seen a huge correction in small and mid cap space, largely because interest rates were going up. And these companies, the smaller companies, do get disproportionately impacted. Also, the commodity prices went up and a lot of these small and mid cap names had margin pressures. Now, in this year, I think we have largely come to the peak of the interest rate tightening cycle, and the commodity prices also seem to be reversing. So we expect the earnings growth for, while Nifty might be 13-14%, for the small and the mid cap space, should be between 18 to 20%. And therefore, we continue to see opportunities on the small and the mid cap space on a selective basis.
Varun, morning. Can you tell us those pockets of exuberance where valuations are a little hard to explain despite an improvement in earnings valuation multiple, the pockets where you would recommend booking profits?
Rima, good morning. So I think as far as we are concerned, we have been booking some profits in the capital goods space, some defense and related ideas, and putting more money to work in some of the more defensive names like pharma and IT. Our sense is domestic focused pharma, the domestic formulation space is very attractively positioned. We expect growth to come back to 10-12% as far as the revenues are concerned, and margins can be a little better as commodity prices cool off. Similarly, some of the mid-cap IT names, which were badly beaten down in the last 1.5 to 2 years, we are beginning to see some new orders coming in, some large ticket deal sizes being finalized. And as such, we hope that both domestic pharma and IT sector to do incrementally a lot better in the next 12 to 18 months.
Okay, domestic pharma and IT, two spaces that you like. Varun, since you're still optimistic on mid caps and small caps, what about these extremely red hot spaces like EMS, or some of these smaller railway stocks, the smaller defense stocks? I'm not talking about the large PSUs, but the smaller, private sector companies, because all of these stocks have risen very, very sharply. What is your view here? Railways, defense, and say EMS.
So good morning, Sobi. I think the most important question to answer in some of these names is how long the high growth rates will sustain. So if you look at the biggest success stories in the last 10 years, some of the consumer finance companies, some, let's say, discretionary consumption names, the most important thing to figure out was how long the 20, 25, 30% growth can sustain. So our view is that as long as there is visibility of growth of 20, 25, 30% for some of these EMS companies, manufacturing companies, and it looks like with the way manufacturing is coming in and some of the PLI schemes are going to kick in, some selective companies may be able to compound at that rate, but not all of them. And therefore, one needs to really pick and choose. The most important thing here is the execution capability. So those companies will have good, clean managements with good track record, respect for shareholder capital. Those are some names we are taking a 3 to 5 year bet, despite valuations being a little on the higher side.
You like auto ancillaries. Can you dive a little deeper into which of the auto ancillaries and what is the theme that you're playing?
So, broadly, Rima, we have seen 2019 was the last year of the auto upcycle in India, and since then, volumes have been struggling both on the two-wheeler and on the passenger car side. This year, it looks like the passenger car space is coming back. The SUV space, of course, continues to be red hot. As the transition from the IC to the green energy space plays out, those auto ancillaries which are able to reinvent themselves and get into new product and ideas which are focused on the EV ecosystem are likely to do well. Some of the companies where businesses are not impacted at all. So whether it's wiring harness companies, whether these are cable companies, some of the lighting focused auto ancillaries, some of them will continue to show good growth, and the valuations being continue to be attractive at this point of time. So we believe from a 2 to 3 year point of view, some of these companies can deliver good compounding.
Okay, got that. Varun, you were just mentioning, right, that valuations in some of these pockets have gotten to levels that are quite frothy. What would those pockets be where you think it's run up so much that right now it's best to stay away?
No, so as I was saying, we have booked profits in some of the select capital good names, some defense and railway related ideas, and we are shifting into more defensive names like IT and pharma.
Okay. Building materials and real estate is also a pocket that you like. For real estate, is there some, any geography that you're particularly keen on, or how would you recommend playing it?
So our sense is, real estate cycle kind of bottomed out during the middle of the COVID, and since then we are seeing, demand continuing to be extremely robust. In fact, on a pan-India basis, the inventory levels are down to around 18 to 20 months, which is the best we have seen in over 10 years. So our sense is, companies with good clean balance sheets based out of NCR, based out of Mumbai, and some select pockets in South continue to do well. So we have to look at companies which are, kind of market leaders in their own respective geographies. Our sense is, if you look at the affordability numbers, the current EMI to take-home salary ratio at a pan-India level continues to be around 35-36%, despite the increase in mortgage rates. And it is much lower than the 50% level that this number touched in 2013. So affordability still continues to be extremely robust. We believe 5-6% pricing growth and 7-8% volume growth. That's something which is quite feasible for the next 2 to 3 years. So 15% kind of growth in some of these names is definitely doable.
No Bangalore-based real estate companies? You said NCR and Mumbai.
So our sense is that some of the pricing growth is more visible in NCR and Mumbai market, and especially the NCR market. Hopefully, as the IT sector picks up, even the Bangalore market should get better.
Okay, got that. So that is on the real estate space. Varun, what do you think about the autos? I know we spoke about the auto ancillary companies, but just the mainstream auto companies, do you think there's lots more to go from here as well? Because a lot of these stocks, the larger ones at least, have run up very significantly this year already. Do you think at these levels they're still attractive?
We continue to avoid the two-wheeler space. I think that's ripe for disruption, and some of the the legacy players might struggle in the short to medium term. We continue to like the SUV space. The passenger car companies should do well. And I think after a lull, we would expect the tractor companies to also start to do well. So those are the spaces that we like in the overall auto space.
Okay, all right, Varun, got that. Thank you very much. Good chatting with you as always. Thank you very much for being with us on the show. And now we look forward to our next conversation.